Good morning, ladies and gentlemen. It gives me great pleasure to welcome you to Hawksmoor's first private client virtual seminar. I'm absolutely delighted you can join us on this auspicious occasion. COVID-19 has completely changed the way our industry operates. We moved the whole team, the whole firm, working from home remotely very quickly and seamlessly thanks to current technology. And thanks to that technology, we can host this conference today and reach far more of you than we would have ever been able to in one physical location. My name is Sarah Saw, and I have been CEO of Hawksmoor since the 1st of January this year. I have 35 years experience in the wealth management industry, 29 years with Brewin Dolphin in a variety of roles, including as an investment manager, before I moved to full-time management. I was the first female director on the main Brewin Dolphin board before moving to JM Finn, where I was head of investment manager for the best part of 6 years. I'm absolutely thrilled to be part of the next exciting phase of Hawksmoor. I'm absolutely delighted to be working with such a great team and with such a great culture. And it is enormous pleasure to be part of the organization. I was particularly attracted to the firm by its client-centric approach. We are here first and foremost to support you and all your investment requirements. And our focus is to do that as well as we possibly can. As part of the strategy moving forward, there are two areas which I particularly want to focus on. The first is diversity inclusion. Not only would I like to see a more diverse and inclusive client base, but also a more diverse and inclusive staff. And we're working towards this. The second area is on sustainability. And it's not just the way we invest our portfolios, but it's also the way we run our company. And I will come on to more about this in the weeks and months to come. I hope you enjoy our presentations today. Please feel free to ask questions using the Q&A button, and we will try and answer as many as we can at the end of the session. Our presenters today are Jim Wood-Smith, Chief Investment Officer, who's going to talk about world markets and understanding them during the pandemic, and James Clark, who is going to enlighten us more on investing sustainably. It now gives me great pleasure to pass you over to Jim and the results of the first poll. Thank you.
Right, thank you, Sarah, and a very good morning, ladies and gentlemen. I hope you can see the results of the poll up on screen in front of you. And we have a good broad spread between those of you who are very familiar with using Zoom and the likes, through to the first timers. So welcome all, and through the wonders of technology, I'm joining you from the fringes of Bodmin Moor this morning, not because I'm on holiday, but because this is where I am lucky enough to call home. And if the anecdotes are anything to be believed, there's going to be a lot more calling Cornwall home soon. The word from local estate agents, just out of passing interest, is that they are their busiest ever, mostly with people wanting to relocate out of London and come to the West Country and work from home. But on with the talk this morning. What we're going to do for the next 15-20 minutes or so is to have a little look at what world markets have done during the year so far, then to sort of take stock of where we've got to, and then most importantly, to have a little talk through where we think that we are all going. So let me start just by putting some numbers up on screen in front of you. And if you just contemplate on the right-hand column, this is the performance of a number of assets during the first half of the year. The middle column, the 2019, is just to put a bit of context about how good a year 2019 was. But I hope if you look at that right-hand column, that knowing what we know about what's going on in the world and what's going on with economies currently, with one exception, those numbers aren't too bad. The standout good point is probably US equity, where the US equity market hasn't really fallen. And I'd also point out the gilts line, where gilts UK government bonds, the safe haven, has done the job that it was supposed to do, and the value of gilts has gone up during the first half of the year. In fact, safe havens have been safe havens. It's not on the screen, but if we had gold on there, then the performance of gold in sterling terms in the first 6 months of the year, the price has risen about 25%. The standout bad number, you'll all have noticed, is the UK equity line. And we'll have a little chat about the UK and why that is in a couple of minutes' time. But let's just move on quickly and look at the US equity market as a proxy for global equity, this time as a line rather than as a number, and superimpose the progression of the lockdowns onto it. And we should get it out of the way at the outset that lockdown is, in terms of economics and economies, hopefully the most catastrophic policy that any of us will ever see. Its impact on economies is simply horrendous. But you can see that in the run-up to the first lockdown in Wuhan at the end of January, then equity markets were still continuing that tremendous run that they had during 2019. And then as the virus starts to come further west, and the news that there are infections in Italy breaks, then equity markets roll over, and then we get the Italian lockdown, and that precipitates what was a genuinely horrendous, in terms of size and speed, market crash. And then right at the bottom, and this is largely by coincidence, we get the UK lockdown on the 23rd of March. And the largely coincidental bit is not because it was the UK lockdown that turned markets round, it was that at that time central banks globally had got into a panic and had started to promise unlimited money to try to fix everything. And that sort of did the trick. But what I want to do very quickly is just to put this into context of the longer term. So here we have the US equity market, the same US equity market for the last 15 years. So on the left-hand side, we're back to the great financial crisis and the market falls that we had then. And then we have 10, 11 years or so of quite steadily rising equity markets. And this is where I'd like to bring in Lenin. And Lenin probably features too infrequently in investment presentations. But he said, worse the effect of sometimes nothing happens for decades, and then sometimes decades happen in weeks. And that's what we've had. So let me try to explain this. So that past decade in which the equity markets globally have performed stunningly well has been characterized by very low, very steady and very predictable economic growth and inflation. There's been a little wobble every now and again here and there, but that has been economically a really dull decade. And in investment terms, dull is good, exciting is bad. And that long period of dullness allowed equities to become a lot more expensive. And if we look at the forward price earnings ratio of the US equity market, in the space of that decade, it went from about 12 to roughly 20. And that is a tremendous re-rating. And that was predicated upon everything remaining stable and dull. And that's now changed because things are anything but stable and dull. And sort of like the poor chap at the bottom of the screen, not seeing the shark behind him, in looking at growth and inflation, everybody was looking for what has ultimately proved to be the wrong risks. So I mentioned the UK earlier on the first or second slide, in which we pointed out what a bad performer UK equity has been. So let's look at that in context longer term. So there's the same 15-year chart, but this time with the UK in red. And so what we can broadly see is between 2005 and 2011-ish, there's not much difference between the US and the UK. But since then, we've gone exactly nowhere, whilst most of the rest of the world has gone roaring upwards. In fact, the UK equity market is pretty much the same level that it was in 2005. But if we zoom in onto the shorter term, if we say that we're the same level that we were in 2005, that US equity market is the same level it was in December. That is a massive difference, and we can see there that the even in the bounce since March, the UK has just been lagging, and there are some very good reasons for both the long and the short term performance of the UK relative to the States in particular, but also most of the rest of the world. One is the structure of our equity markets. So the largest companies in the UK, we have a preponderance of what we might call old economy businesses, oil companies and banks. If we look at the largest companies in the US, they'll all be household names to you now. So we have Amazon.com, we have Apple, we have Microsoft, we have Alphabet, the company that owns Google, we have Facebook, we have Visa. Those are the 6 of the 7 largest companies in the States, and they are very much more companies of now and of the coming years than the UK market is. Slightly longer term, well, we've been through the Corbyn risk period, but we haven't got out of the Brexit risk period yet, and a economically bad outcome of Brexit, meaning no deal, is still very much on the cards. In fact, I would argue it has probably never been more on the cards. It is becoming more and more likely that no deal is where we are going to get to. And the world sees that as a risk. And were you sitting in New York on Wall Street, or in Frankfurt, or in Tokyo, or in Shanghai, and you look at the UK, you might be tempted to think, well, it's a pretty small part of the world. It's only 4% of my available investable markets. It's got tremendous local risks. Why do I bother? And that, I think, genuinely is the way an awful lot of international investors look at the UK currently, and have been for quite a while. But if we've been looking at the equity markets, and I mentioned earlier that there was a certain panic amongst central banks, the spike on this chart is what caused that panic. And this was where the capital markets started to repeat the beginnings of the great banking crash, or the great financial crisis. So what we have here, that doesn't come over terribly clearly, is a sharp rise in the yield on UK gilts. It's only from something very, very tiny to something not quite so tiny, but it was in percentage terms, that is a very large and very sharp move. And what was happening was that investors around the world were saying lockdown policies are going to make governments go bust. And COVID is going to make countries go bust. And we don't trust government debt or gilts, and we're going to run to cash. So this was just a sign that global investors were selling their government bonds and going to use £20 notes and used $100 bills. And that meant the banks had to do something. And by Jiminy, have they done it? And to their credit, the central banks learned the lessons of the great financial crisis, and they've done the precise opposite of what they did then. Their first reaction then was to take all their toys and go home and said, we don't want to lend to anybody because it's too scary. This time round, they have said, here is as much money as anybody wants. And if you want infinite money, actually, we'll print infinite money. And we've started to see the first evidence of what some people call helicopter money here in the UK, which is just government handouts. So Rishi Sunak is now giving handouts so that we can eat half-price fish and chips on Monday, Tuesday, Wednesday. And is also, this is actually much more interesting and much better from him, he's going to start paying for re-insulation of housing and upgrades of boilers. But the magnitude of this money is staggering. So promises from the US so far, about $4 trillion in the UK, promises of about £500 billion. It's a staggering amount of money. And the Eurozone, I'm probably being very conservative there at trying to work out that the promises so far are 2 trillion euros. They're probably actually 3 or 4 trillion euros. These are monstrous amounts of money. And in the short run, at least, that's done the trick, because financial markets have stabilized, bond yields have stayed more or less static, equity prices have risen, in some cases slightly, in some cases quite a lot, but the important bit is that they've stopped falling. And also economic activity has at least stabilized, and for the time being is probably getting slightly better as various parts of various economies open up again. The extent of the economic damage, though, is huge. So there's a very wide range of what might happen in the developed world this year. So best guesses are a fall of between 5 and 10%. To a bit of context on that, if we look at what the US economy did in real terms in the Great Depression, so 1929 to 1932, the US economy shrank by 15%. This year, it will achieve probably between half and 2/3 of what it did in the whole of the Great Depression of 29 to 32. So it's really quite difficult to overemphasize what the economic hit is. So we have this huge economic hit, and we have this massive wave of money. So, well, what does that mean? Well, range of views from everybody for what might happen in 2021 range from we're going into depressive austerity to we're going into inflationary boom. The spectrum has arguably never been wider. And what's that money doing? Well, there's an explosion in the growth of money in the UK. or that's what we would be saying if we saw the 11% year-on-year growth as an isolated number. But if we put it next to the US, it looks quite small. US money is genuinely growing currently at 25% year on year. And unless that comes down, the US has a big inflation issue coming. And it might come down. We don't know, but it is a number that we are watching extremely closely. But this is where we get into the more optimistic side, because there is a more optimistic side of COVID. And it's when we try to combine COVID and climate. Because COVID and other such diseases are not the UN's greatest risk. That remains climate change. So all the climate change issues that we've been talking about for so long are still here. And what COVID gives is the opportunity to do something about it. And Greta Thunberg, I'm sure half of you have groaned at seeing her and half of you have smiled at seeing her. But she's taught quite rightly that the issue is that everybody knows what the solutions to climate change are, but they're not going to get done because they're too difficult and too painful and too unpopular. What COVID has done has to bring all that pain from the changes to economies into the first half of 2020, and it's made achieving decarbonisation very, very much more achievable. The issue is whether anybody will actually do it. And we know some of the transformations COVID's done. We're all familiar with the increase in what we call digitalisation, the move to the online world. We know about the move to home working. And I started off talking about anecdotes of the move from the home counties to the West Country, for example, and I'm sure other areas around the country are just the same. But if we think about how things have changed, if we just think about electric vehicles, the biggest handicap, the biggest obstacle to the take-up of EVs, arguably our lack of confidence in their range and the shortage of charging points. But if COVID and the change in working habits and working patterns means that we're all driving a fraction of the mileage that we used to, then we get past a lot of those objections to the EVs. And it's quite possible that we're going to see a massive acceleration of electric vehicle sales. And what we're having, every business has to deal with both COVID and decarbonisation. We are committed as a country to net zero carbon by 2050. Most businesses have not yet really started to grapple with quite how much that change things. But a lot of those issues are the same issues that they've got to deal with in about adapting to the post-COVID world. And that is the opportunity and the challenge that everybody's facing. And there will be leaders and there will be laggards. And our job is to differentiate between those two. And if we just look at one very quick example here, and this is just an easy one to do. Amazon.com, we know, arguably one of the greatest beneficiaries globally of COVID and the shift to online shopping. Marks and Sparks, which in terms of carbon is a genuine global thought leader. The environmental policies at Marks and Sparks are fantastic. In terms of giving an online offer for its clothing business, it's hopeless. But some of this differential hasn't happened yet. So here we have share prices this year of BP and Exxon, and the two have done exactly the same. The market has said an oil company is an oil company is an oil company. But the outlook these two businesses have couldn't be more different. BP sees its future as a non-oil business. It sees its future as a renewable energy business. Exxon sees its future for decades as a hydrocarbon business. So at some stage, those two businesses are going to start to perform very differently. And I wouldn't want to prejudge which one's right and which one's wrong, but they have totally different outlooks for the next 20, 30, 40 years. But at the moment, the market has just said they're both oil companies, but they're not. So just to try to wrap everything up very, very briefly, our response to COVID was to reduce the risk in our portfolios during March. So we reduced our equities, we increased our cash, we increased our sovereign bonds, we increased our gold, we increased our safe havens generally, and we also shifted more out of the UK and towards overseas markets. We put our first toe back in the water in May. It will probably take us the rest of the year to get the whole foot back in the water. And probably above all, what we have is an absolute renewed focus on the identification of the businesses that will be the transition leaders through this. And we find these both in the UK, we find them outside of the UK. So I suspect that there will be even more non-UK investments in our portfolios. And we really find these in the so-called sustainable portfolios and sustainable funds that we invest into. And on that note, I thank you very much for your attention in watching and listening. And it's my pleasure now to pass you on to my colleague, James Clark.
Ladies and gentlemen, please vote in our second poll this morning. Around about 10 seconds left if we can. And let's have a look at the results if we can. Excellent. Okay, so a really strong majority indicating a preference for at least considering sustainability in your investments. So that's music to my ears. Okay, thank you. And good morning, ladies and gents. My name's James. I'm a fund research analyst here at Hawksmoor based in the Exeter office. And my section of our seminar this morning is on why sustainable investing is here to stay. So we're going to touch on what we think is the link between COVID-19 and sustainable investment. We're going to have a look at some performance in this area, the UN Sustainable Development Goals. We're going to have a quick look at a campaign that's going on at the moment, and also consider some counter-arguments in this area. And we'll wrap up with a look at our sustainable world offerings. But first, a quick look back almost at lockdown and just some of the remarkable scenes that we've seen and experienced over the last few months. We have here a deserted Piccadilly Circus in London, some empty planes stacked up on the runway at Hong Kong International Airport. A lady working from home here in Europe, and some empty supermarket shelves over in the US. Just a few images just to remind us of the kind of world that we've all been living in over the last few months. But it hasn't all been bad, and we've got here a couple of photos from India. The level of, in Delhi, from the top photo, the level of pollution considered most harmful to human health fell by nearly 60% in just a few days following the imposition of India's lockdown. Elsewhere in the country, villagers could enjoy clear views of the Himalayas for the first time in decades. So it hasn't all been negative. So why are we showing you this? What's the link with sustainable investing? Well, we think it's this. We think COVID has accelerated changes in behaviour and attitudes towards sustainability, which were already underway. This is not new. COVID is just the accelerant to this shift towards a more sustainable world. But what might that actually look like, and what do we really mean? Well, we think there's going to be even more of a move from the physical to the digital domain. Recently, the chief executive of Microsoft has said that the company's seen more than 2 years worth of digital transformation in just 2 months. We're going to need more capacity and resilience in IT systems, data centers, communications towers. There's going to be more online shopping, even more online shopping, more online communication such as this, online education as well. Jim's already touched on less travelling for work and the quicker adoption of electric vehicles that this allows. But there'll also be more consideration of sustainability when we do have to travel, for example, taking flights or taking the train. Linked in with this, there's going to be more appreciation of renewable energy and awareness of the effects of burning fossil fuels. And linked into that, more appreciation of efficiency in both domestic and commercial settings, where energy efficiency can really still be improved. And finally, healthcare investment. We don't need to tell you that healthcare investment needs to increase, covering everything from small items in the supply chain right the way up through to mission critical items in the intensive care units. And above all, resilience. A lot of these points link to resilience. So that's all well and good, but again, what's the link with sustainable investment? Why are we talking about this? Well, it's this. Many sustainable investment strategies already invest in these themes and have done for years, decades in some cases. Some of the longest established sustainable funds are now 25, 30 years old. Investing in themes such as health, well-being, safety, education, clean energy infrastructure, improving the efficiency of energy use. Now, what we have here on this slide is just a snapshot of themes, pursued by just 3 of the funds that we invest in: Web Sustainability, Von Tobel Clean Technology, and one of the Lion Trust Sustainable Future funds, which we'll return to in a minute. So we could show a lot more themes in this. This is just a snapshot. But the point is that sustainable funds are already pursuing these themes, and they're really well placed. But if those are the themes, then what kind of actual companies and investments does this look like? So I have here a couple of examples. Again, we could select many more, but in the interest of time, we have just 2 this morning. So fitting into a theme such as improving the efficiency of energy use would be a Japanese company called Daikin, which makes really efficient heating, ventilation, and air conditioning equipment. Air conditioning accounts for around about 5% of domestic residential energy use globally. Ventilation and cooling each account for about 10% of commercial energy use globally. So you can see that there's a lot of potential for reducing energy use with really efficient centralized air conditioning and cooling systems, which Daikin manufactures. The second example, quite a popular stock among sustainable investment funds, is Thermo Fisher Scientific, which makes and distributes a range of laboratory and testing equipment for a range of scientific disciplines. Thermo Fisher equipment was used to sequence the COVID-19 virus genome. One of their microscopes was used to show the first 3D structure of the COVID protein. And the company's producing over 5 million diagnostic tests per week. really at the forefront of the fight against COVID-19, and hopefully on this slide, a couple of interesting examples of the kind of companies that sustainable funds actually invest in. But what about an example of funds themselves? Well, again, in the interest of time, I'm afraid we can only touch on one. We could show a number of really good examples, but here we have Liontrust Sustainable Future Global Growth, which is really one of our top picks among a peer group that we think is the best for sustainable investors in the UK. It's the global equity funds. And this one, as you can see from the chart, has performed really well, particularly stretching away from its peers since the back end of 2017. Now, this range of funds, of which we invest in three, invests in three broad themes: better resource efficiency, improved health, and greater safety and resilience, with around about 20 sub-themes therein. Many of the companies that they invest in fit into more than one sub-theme. And as you can see, performance has been really good. But investing in sustainable services is not just about us researching a few funds, putting them together into a portfolio and saying, there you go, we can provide sustainable investment. It's about allowing investors the opportunity to combine their investment objectives with supporting the UN Sustainable Development Goals, the 17 tiles for which is shown here on the slide, and there are 169 underlying targets. More and more of the funds that we invest in are mapping their investments to the support of the Sustainable Development Goals. And it's at this point that we can link in impact investing. Impact investing is targeting a tangible positive impact on the environment and/or society, as well as investment objectives. So, for example, one of our favoured funds, I've already mentioned, Web Sustainability, invests in 9 positive impact themes, which supports 7 of the Sustainable Development Goals. Now, impact reporting, where fund management groups report on the sustainability impact of their investments, as well as the financial objectives and impacts, is really a developing area, but different fund management groups are progressing with that at different rates. Some are very advanced and some are really still getting started. But we'd like to offer this and report on this at the portfolio level, but that's difficult at the moment whilst this is still such a nascent area. It relies on investee companies reporting on the positive impact of their goods and services. And in many cases, that's still estimated rather than tangible and measurable. But nonetheless, we can still see some really good numbers coming out of impact reports. So for example, Web Sustainability. Last year, £1 million invested in the strategy was associated with the avoidance of 850 tonnes of carbon dioxide emissions, the treatment of 11 million litres of wastewater, the recycling of 155 tonnes of valuable discarded materials, and the provision of healthcare treatment to 160 people. And that's just a snapshot of some of the positive impacts of one of our funds. So if you put all of it together, the funds that we invest in really are doing some meaningful good. And on that note, we can touch on a campaign very recently launched, actually just at the end of June, by Richard Curtis, who was also involved with Make Poverty History and indeed was a co-founder of Comic Relief. Now this is Make My Money Matter, which is really all about knowing where your pension money ultimately goes. On that note, they have a really good tagline, pensions with intentions, calling on individuals, organisations and governments to know where their pension money is invested and to push for it to be invested sustainably. And as such, this is basically a campaign supporting sustainable investment. And in turn, it's really strongly aligned with our Sustainable World services. We want to help make your money matter. So I would encourage everybody to have a quick look at least at the Make My Money Matter website. But what are the counter arguments to all of this? We've presented quite a few pros, if you like, in terms of sustainable investment. What about some cons? Well, the most obvious one is a low oil price, as we've seen recently in the wake of the COVID-19 induced market sell-off. A low oil price provides less incentive for economies to transition to a more sustainable way of operating. If oil is cheap, why not just continue burning fossil fuels? The second photo we have here, a diversion. Is COVID-19 proving to be a diversion for authorities and governments in terms of the work that they were doing on transitioning to a more sustainable economy and a more sustainable way of life effectively? We really hope it's not. Other factors here, simply people's attitudes and behaviours towards sustainability. Are they too entrenched to shift quickly? And along a similar line, company supply chains, massive integrated supply chains for global businesses. Can they adapt to a more sustainable way of working? But overall, we think that the positives are a lot stronger than these negative counter-arguments and will come to the fore. So, what do we actually offer at Hawksmoor? Well, within our discretionary portfolio management service, we've been offering a sustainable service since early 2017, managing bespoke portfolios by the same investment managers based in the same offices across the Hawksmoor branch network. So these are portfolios using the same framework, same processes and procedures as for what we might call traditional portfolios. The only difference is that we run a sustainable buy list of collective funds, investment trusts, and direct equities. And therein we can cater for specific client exclusions. We have here on this slide a snapshot of a quarterly Sustainable World Investors report, which we write to go out alongside client investment valuations, reporting here on the developments in the sustainable investment space, focusing each quarter on one specific fund that we invest in, and reporting on wider sustainability developments. There's a new issue, brand new, just coming out right now, in fact. So if you haven't seen one of these and you would like to, please contact your investment manager or a member of our sales team. So if that's what it is, how's it performed? Well, the best way to illustrate this, because each bespoke portfolio is obviously slightly different, is this illustrative portfolio track record. So we've been working in sustainable investment since the back end of 2016. And in March 2017, we established an internal illustrative portfolio, which was really early guidance for our investment managers. So you can see the track record here. As at the end of June, this portfolio was up by just under 20% versus, I think it is just under 7% for the comparable portfolio from ARC, which is Asset Risk Consultants. This is effectively a benchmark that we use. So you can see the strong performance of sustainable stocks and themes has obviously translated into sustainable funds that we invest in within these portfolios. Everything's been going well, performance has been strong, and you can see that on this slide right here. So, quick recap. Hopefully we've made a good argument on why sustainable investing is here to stay. And what we think is the real crux of the argument here, COVID having accelerated changes in behaviours and attitudes towards sustainability in a more sustainable world, which are already underway. COVID is the accelerant. Performance is strong. We can all support the UN Sustainable Development Goals. We've touched on the campaign, Make My Money Matter. And we really think that Hawksmoor's Sustainable World portfolios are a good solution. If you are interested in sustainable investment and haven't yet got involved, as I say, please do speak with your investment manager or a member of our sales team. Thanks very much. Thanks for listening to me this morning. And I'm going to transition back to our Chief Executive, Sarah Saw. Thank you.
Thank you very much, James. Absolutely fascinating insight into the way we've been investing sustainably for some time. And in fact, as we come up to the question and answer slot, which I'm going to keep reasonably brief in the interest of time, although I think there have been some great questions coming through. And I hope the lady who asked the question, as a company, are you groaning at Greta Thunberg? I hope you can see that the answer is no, we are definitely not groaning at her at all. Indeed, we are embracing what she is saying. Well, we've got a good couple of other questions, which perhaps, Jim, I could come in on a great question here, which is, what's been your favourite buying opportunity of the COVID period?
just for a moment there, I was hoping Josh was going to answer that for me. If everybody else got a glimpse of Josh there, Josh is the magician behind the scene who's made all this work for us. That's my spiel whilst I try and think of what the answer to the question is. So our favourite buying opportunities. I think if we go back to February and March, then broadly every share price in the world got including some of our very favourite businesses that we thought were going to benefit from this. And so I think I'd probably say that the two best buying opportunities we saw were in two fund management companies who have expertise in the sustainable investment management world. So the two businesses were called Lion Trust, which featured one of their funds featured in James's talk, and the other is a company called Impact Asset Management, which is an AIM-listed sustainable and environmental investment expert.
Brilliant, thank you, Jim, very much indeed. We have another question here. Sorry, I've got so many questions coming through. You'll just have to all bear with me. And another one for you, Jim, actually, which has just come through, is what about the effect of China, where we seem to be falling out?
Oh, wonderful question. The issues with China are massively complicated, and believe it or not, environmentally linked. Environmentally linked and Trump linked and Brexit linked. We have a government in the UK that is quite rightly determined to get us out of Europe, and will do so with a no deal if it possibly can, and wants to do trade deals with the US in particular. So we are quite happy to follow the US's lead on anti-Chinese policies. We also have a massive divergence between the US and the Chinese governments on environmental issues, and this actually really matters. Trump as we know, is a denier of climate change. The Chinese, believe it or not, are the global drivers of decarbonisation. The Paris 2015 agreement was not agreed at Paris. It was all agreed beforehand between China and the US. But we then had Barack Obama as president. COP26, which was supposed to be happening in Glasgow this year and is going to happen in Glasgow next year, is probably going to be as important as COP1 was. And this time, although the States has fallen out of it under Trump, there are going to be huge changes that come in COP26, and they're being driven again by China. But this time the agreement to get it through is not with the States, it's with Europe. So it's a massively complicated situation. I think it will all come out in the washing when there is regime change in the States. Whether Trump loses the election this year, or we have to wait another 4 years, the Chinese are probably saying they don't care, they'll play the long game, because they know that there will be regime change and there will be a government in the States that knows that it's better to do business with. Sorry, that was a very long answer.
Thank you, Jim, very much indeed. I'm going to turn to James for a question. We have so many questions coming in. Unfortunately, we're not going to be able to answer them all now, but hopefully we can come back to you individually to answer your questions if technology allows us after the presentation. But James, is all the hype about sustainability going to create a dot-com type bust in the future?
Yes, I've seen that one coming through on the Q&A. Thank you for that. We would say no, but we do want and we do see the funds that we're investing in, by and large, being very, very aware of what we effectively call sustainability darlings. And we want to see fund managers, the funds that we invest in, taking profits in these kind of situations and recycling them back into more fairly valued opportunities. There's definitely a small cohort of sustainability darlings, companies such as Tomra, which is a Norwegian company which makes reverse vending machines, whereby basically you put a plastic bottle into a vending machine in a supermarket car park. It spits out a token to use as a small discount in that shop, and then the plastic bottles are collected and taken away for recycling. That's a absolutely booming market globally, and Tomra's got something like 70% global market share. So the potential is just staggering. But investors have cottoned onto that, and the share price has gone from the bottom left to the top right hand corner of a chart, and investors have already done really, really well. So what we want, and what we have seen indeed, is sustainable fund managers taking profits there and recycling into opportunities where that hasn't taken off to such an extent. So it's definitely something that we're wary of, but as we've argued, in the grand scheme of things, sustainability's got so much further to run that it's not an overriding concern at the moment.
James, thank you very much indeed. I'm very conscious of time, so I'm going to pick up on a comment from a gentleman who has said, now that you have done this informative and useful presentation, do you plan on doing more of the same? Well, you vote for yes, and I'm pleased to say, yes, we definitely do intend to do more of the same, technology permitting. And I also know that technology for some people meant that they couldn't see the voting polls. Unfortunately, that's the way you are logged on to the presentation. I'm afraid that was unavoidable for some of you, so apologies for that. So I'm going to wrap up by thanking all. We have at least 120 people on this presentation this morning attending, which is quite fantastic. So thank you all for taking the time to join us today, and I hope you found it interesting. And certainly from the comment that that gentleman made, I think that certainly we've got one vote anyway, which is great. Thank you. I hope Jim managed to make sense of markets in these strange times, but James talking about sustainability, and to highlight the fact that we've actually been looking at this area of investing for at least 3 years or more. So it's very much part of our hearts and will continue to be so. As you will have probably noticed, this has been recorded. So if you want to look at it again, it will be on our website. And as I said before, I will aim to try and come back to you, or we will try and come back to you with answers to all the other specific questions. I saw questions on Tesla, questions on investing directly in shares. The answer to that is yes, we definitely do, and a lot more, but not for this session. We are going to put out a feedback form, SurveyMonkey, and we will be really grateful if you could give us some feedback, because it helps us to hone the contents of the presentation and regularity and that sort of thing. As I've mentioned, technology has enabled us to do this, but as with all positives with technology, there are negatives, and this is particularly in relation to cybercrime. I'm sure you've been told this many, many times, but please be vigilant. Beware of suspicious emails, phone scams, pop-ups, misleading websites. Some things can be very deceptive, but never disclose your security details, and just don't always assume that an email or a phone call is authentic, and never be rushed or pressurized into anything. Just listen to your instincts. It is really, really important. I finish by saying thank you very much again for attending. Stay well, stay safe, and please do stay safe online as well. It really is very important. Thank you very much, and good morning.